Reporting season kicking off next week with ANZ and then a Westpac and NAB in the second week of November. And then we've also got a first quarter trading update from CBA in the middle of November. Now, look, new to the sector, I suppose I was trying to sort of work out how to sort of frame my thinking on looking at the banks. And this is a chart that I've put together. Hopefully you find it useful. But, if I look at it here, just in terms of, the structure of the P&L, net interest income's the big number to be looking at here. It's about 80% of the revenue for the banks now. It didn't used to be this much, but with the reduced complexity of the banks as they have divested non-lending assets, the net interest income has become particularly important. So how do you need to think about that? Well, that is effectively the interest that they earn on their lending assets and their liquid assets, less the cost of the funding of those assets. Now, the banks kind of reworked that statement into basically talking about their net interest income, the net interest margin, and their average interest earning assets. So that's what I'll be sort of be focusing on with this presentation. But just if you look through that P&L and sort of see how it comes together at the bottom there into profit after tax, compare it to the book equity of the business. Now, that gets impacted by particularly what the regulator says they need to do with the amount of regulatory capital they need to hold aside. That gives them the return on equity. Compare that to the cost of equity of the business. And that really sort of gives you an idea about whether these banks are adding or losing shareholder value. So that's kind of like the framework that I've been working to. I suggest you sort of have a bit of a read through that chart just to sort of get your heads around it. It makes it a lot easier when talking to clients, I think. So first up, I think I just want to talk about that net interest income, and the two real sort of key components there are what's happening with loan growth and what's happening with that net interest margin. So firstly, on the net interest margin, look, RBA cash rate is like a key consideration here. For the second half of 22, the cash rates did move up a lot, but they moved up, I suppose, a lot in like a back-ended component of that half. So we are going to see a kicker coming through on that front, but it is going to be more of a FY23 and even into FY24 type story. Now, my modelling requires an assumption about what that cash rate's going to be. And I've informed my choice on that from what the yield curve is implying. And the yield curve at the moment is, as we know, quite volatile on this front. And it's somewhere between 3.5% to 4% is where it's assuming the cash rate tops out. My modelling, for your information, assumes it's sort of what they call a terminal rate of 3.8%. So I found it was really interesting when the ANZ CEO was in here and we got him talking about the direction of the NIM over time. And he made a comment that the NIM had fallen for the last 30 years. And that's the chart that I pull out of an RBA pack that actually shows that. It's just been on a constant decline. And then he also made the comment that we're expecting a sugar hit to that NIM over the next sort of 12 to 18 months. So that's certainly what I've got built into my numbers. That sugar hit comes from that rising rate environment because the banks can leverage the interest rate incentive components of their deposit books. They've got the equity capital that they built up over time that has no interest costs attached to it or no direct charge. They've got this amazingly cheap funding facility that the RBA provides. You might hear about it, the term funding facility. It was put in place during COVID. It's at a fixed rate of somewhere between 10 and 25 basis points. You look at where bank bill swap rates are now, I mean, they're getting a hell of a lot of value, a hell of a lot of kicker out of that. That facility expires in the middle of 2023 across to 2024. So a real benefit at the moment, but will turn into being a headwind to the NIM as that needs to be refinanced. You would have heard the story about the fixed rate loans that they had into the market during that sort of COVID period. They're effectively a headwind at the moment because fixed rate loans are lower margin than variable rate loans. As those fixed rate loans expire, and there's a real peak of that coming in the middle to late of next year, then expect those to actually probably go on to variable rate loans. Should see a margin improvement there. And then finally, the banks have these things, so it was a new thing to me to learn about, called replicating portfolios. I won't get into the detail of it, but effectively they're a rolling swap book, which basically smooths out the volatility in their earnings. as swaps have moved higher over time, we should expect that the earnings on those replicating portfolios actually increase too. So those are the things that are going to lift the NIM in the short term, but I don't think that NIM benefit's going to last forever. So the headwinds, look, number one thing sitting out there is just this intensely competitive market for both loans, and it will come over time for term deposits. You've got increased wholesale funding for the banks, and certainly there was a chart that CBA provided in their result pack showing how much the wholesale funding has increased for banks. You've got the refinancing of that term funding facility, and then also the regulator requires that as the banks put or hold more deposit money, they've actually got to hold more liquid assets to partly offset that, and that creates a headwind to the net interest margin also. Second thing to think about here, and I should say on that chart there, you can actually see the profile that I'm using within my modelling, and that's sort of discussed a bit more in the report. Second thing is I suppose the growth in the interest earning assets. Look, I found this chart particularly interesting to sort of inform my thinking of how their asset base is actually set up. And you can see here what interests me the most. Everyone sort of talks about how CBA has the most defensive sort of asset base, which is so concentrated in home lending. When I go through this here, what I really see is that Westpac is not actually that much different. And it's quite obvious also that National Australia Bank and ANZ have got a lot more of a focus on the business banking side of things, so less of that lower risk home lending. Recent data that comes out from an RBA and from APRA shows that system loan growth has been very strong, and same with the deposit growth. Heaps of liquidity in the system. The major banks, they have picked up on that growth, but they have faced some very fierce competition. And if you look at the data, what really stands out is Macquarie is an out-and-out predator in this space. It has been absolutely gobbling up market share. Probably the one that looks like it's taken most from has been Westpac. NAB's been strong. CBA has been strong, but sort of looks like it's taken the foot off the pedal a bit. And I think that's they made reference to these cashback offers in the market. They just don't want to compete on that side of things. Westpac, ANZ have languished somewhat due to their internal issues on that front. Look, in my modelling, I've assumed that system growth slows through until FY24. Obviously, we've got those higher cash rates. That's going to have an impact, you would have thought, on borrowing before the market turns back to sort of long-term trend growth in loans. Back to this chart here. Look, I think another important item in the P&L that we've really got to be thinking of, it's a big swing factor that can come through in these numbers, and that's the credit impairment charge. I've labelled it there as the loan loss expense. Look, bit of history here. When COVID hit, the banks put big loan loss charges through their P&L to bolster up their loan loss provisions. Disaster didn't occur, so they've been releasing those excess provisions through their P&L. So that has actually made their earnings and their ROEs look a lot better than they really are on an underlying basis as they've been releasing those through. Now, the point on asset quality here, look, there's been plenty of informed discussion on this. The RBA has done some great work. It has access to data that not all of us have. And it suggests that those substantially higher interest rates are really not going to see a material decline in asset quality. The thing you should be thinking about here, I think, when you're talking to your clients is first and foremost unemployment levels. We're at very low unemployment levels at the moment. I used to work in lending. The two things that banks care about the most is, number one, the interest gets paid, and number two, the loan gets repaid, whether that's amortized or at the point of a bullet refinancing. The most important thing there, at least for the home loans, is the unemployment. If you've got a job, you keep paying your mortgage on your debt. The second thing is the strong property market. Now, we've heard the stories about, yes, the property prices are sort of falling over a bit, but they are certainly up way further than they were literally 2 years ago. So the value of the collateral for the banks is there if there is an issue with unemployment coming through. Nonetheless, I think those loan loss expensing, it can't stay as low as it is. In fact, the release is going through the P&L. So I've built a headwind into my numbers. I think that's conservative. So a headwind into the earnings forecast. that see the expensing return to long-run loan loss rates by FY24. I don't think I'm alone on that front. It looks like that is what consensus is also building into its numbers. So when you dig into my numbers, and I won't go through each of the banks here, what you'll see is some pretty strong improvement in earnings and ROE over the next couple of years before that really strong competition starts to chew into that NIM benefit, and also the ramp up in the expected credit loss expensing starts to come through, and you start to see a bit of weakness in sort of late 24 into FY25. In that scenario, I think we can get some good profit growth coming through, but the dividend growth coming through. And I think also the banks will be able to generate surplus regulatory capital, which means they'll actually be able to do more buybacks. I've been thinking that they are probably more of a FY24, FY25 type timing, except for those that are underway at the moment. And that's partly because APRA is putting through a change to its capital adequacy framework that should come into play from January next year. So we'll just wait to see how that is understood. On to investment views now. Look, there's the performance of the banks over the last week, month, quarter, and year. They've had a very good run compared to the market. So look, ANZ and Westpac have been the strongest performers over the more short term. I think the ANZ one is more to do with the rebound from its capital raising. If you look a bit longer term, NAB has actually been the strongest performer. They've all outperformed the markets. So the high beta element of those stocks really come into the fore. In terms of my investment views, I'll go through them one at a time. So ANZ, I've retained a hold on it. If I think about these dividend yields is inclusive of the franking credit, ANZ's on about 8% at the moment. Look, if you look at the total return, you'd say, hey, that's probably sitting within buy territory. I'm just a little uneasy on this one at the moment. ANZ is seeking approval to establish a non-operating holding company so that you can actually set up like a unregulated sort of financial services subset. Part of that, I think, when the announcement came out that they were looking at MYOB was a little bit disconcerting. They've obviously also got the takeover bid for Suncorp Bank, where the government approvals, so that's ACCC, Federal Treasurer, and Queensland Government needing sign off. So there's just uncertainties on that front. And in the meantime, they're carrying the capital from that, the capital raising. CBA, I have lifted from reduced to hold. Look, to me, this one is the lowest risk, highest quality, highest ROE, most favoured institution amongst customers and consumers and businesses. And look, it's a leader on the technology side. What you counter to that, I suppose, is you are paying for that in the valuation multiples that are far ahead of its peers. NAB, I have held at hold, 8% yield. Look, I think investors have really bought into the vision of the CEO. So this is the CEO who once ran CBA's retail business and really was expected to be the next sort of CEO of CBA some years ago, but since moved on. Look, it now trades at a premium to ANZ and Westpac, and that's deservedly so because it's managed to boost up its ROE above both those peer banks. Westpac, I have lifted from hold to add, grossed up yield 9%. So look, like I said before, Westpac and ANZ, they've got similar proportions of home lending in their lending portfolios. Westpac relies or is heavily reliant on deposit funding, just similar to CBA, but it trades on a way lower price to book than CBA. And that's because its ROE, I think, is a lot lower. And I think it can improve that ROE. And these are the four reasons that I think they could actually get that done. So first up, they've got to get their originating and processing activities in order so they can arrest that market share loss. And they certainly are, that is a part of their strategies. It's obvious when you do the sort of compare and contrast across the banks that Westpac has the heaviest cost structure, and it's certainly working on reducing that. It may have the greatest short-term leverage within those replicating portfolios I talked about. They have a shorter investment term, so they should get a quicker kick up on those investment portfolios from the higher rates coming through. And the final thing that I I sort of pick out, I suppose, is just in terms of the regulatory capital intensity of their non-housing mortgage book. It's a lot higher than its peers. The others are very similar. So if it can reduce the regulatory risk intensity of that business loan book, if I can call it that, there'll be more surplus capital that can actually use on buybacks. That'll also improve the ROEs and support a higher valuation also. So that's it from me. Any questions, please fire away.